Well, Alibaba has a very unique corporate structure as a variable interest entity. And joining us now to discuss that and more is Dennis Hudachek. He's a senior ETF specialist with ETF.com. Dennis, good to have you on the show tonight.
Thank you for having me.
Dennis, Alibaba shares down 4.3% on the second day of trading. Why are we seeing this drop? Was Alibaba just hit by the overall negative sentiment on Wall Street today and the signals from China that it would not increase stimulus, or are there other issues at play here?
Well, I think we first need to take into account that Alibaba shares jumped 38% on the first day of trading last Friday. And I mean, what we're looking here is a 4% pullback, literally the day after this massive surge in Alibaba shares. I mean, I think it's a little too soon to draw any kind of conclusions from this move. It can simply be that investors are maybe taking profits at the moment. But I think the bigger takeaway here is that Alibaba is a very high-profile IPO. It was very hyped. And this sort of volatility is somewhat of a norm for this kind of stock. So, you know, I think investors in Alibaba need to be braced for this kind of volatility going forward.
Well, Dennis, with regards to the hype, there was a lot of concern pre the IPO that the pricing of the share would be at the right range to avoid a post-IPO drop, which is common with such a hyped company. Now, we saw that with Facebook that held the record of the biggest tech IPO before Alibaba. So do you think this is due to Alibaba pricing at the higher end of its range, given that it went from $60 to $66 to $66 to $68, or again, just too soon to tell?
Well, again, I mean, not necessarily. I think I'm going to go back to, you know, stating that Alibaba shares, I mean, we have to remember they jumped 38% on the first day of trading. Now, if you look at
it's a big premium.
It's a big premium, and you can make the case that I think Alibaba probably could have fetched a lot more than $68 a share on its IPO pricing.
Right.
Now, comparatively, you go back to Facebook a couple years ago, you know, on the first day of trading on Facebook, the shares basically went nowhere from its IPO price. So I think it's a little too soon once again. It's the second day of trading. I think we just need to kind of see how this thing plays out, let the volatility ride itself out, and see what happens from here.
All right, well, Dennis, one of the issues that could certainly impact the share price is Alibaba's exclusion from an ETF, an exchange-traded fund. Alibaba is, as we know, headquartered in China, but it's incorporated in the Cayman Islands, and that's in order to bypass a law that prevents foreign ownership in Chinese companies. So it's therefore excluded from the S&P 500 and the MSCI indices, and this could create major issues. What are they?
Well, that's a really, you raise a really great point here. So when you look at ETFs, the problem with Alibaba, like you mentioned, is that it's incorporated in the Cayman Islands. But more than that, its actually sole listing is in the US as opposed to Hong Kong. And what does that mean? It means that it automatically makes itself ineligible for inclusion, not just in MSCI, but in all the major FTSE emerging markets indexes. And there's hundreds and hundreds of billions of dollars that are tied in ETFs that track these larger MSCI and FTSE-based emerging markets indexes. So, you know, there's a case to be made. It's certainly a hurdle. I mean, I'm not saying Alibaba can't, you know, overcome this hurdle, but it is a hurdle in the sense that there's hundreds of billions of dollars at stake here that may not be able to invest in Alibaba.
At the moment, it's excluded. So what does this mean for the share for investors?
Well, I mean, once again, I think you have to take this in a context too. I mean, we're talking, when you look at the MSCI Emerging Markets Index, there's roughly $210 billion that are benchmarked to that index in passive funds. Now, passive funds means that these funds have to, you know, they would have to buy Alibaba shares. That's no longer the case because they're not eligible. But when you look at active funds, there's over $1 trillion in active funds that are benchmarked to the MSCI Emerging Markets Index. So, you know, it's more about price. I think it's more about stability. Being able to be included in these indexes tends to create some sort of stability because indexes don't really churn the way, you know, a lot of active funds do. And a company like Alibaba, once it's in these major indexes, it'll probably stay in there forever in some of these broad-based emerging markets indexes.
Definitely more stability. Now, Dennis, there is some talk about some indices manipulating some of the rules and regulations to include Alibaba. What are your thoughts on this and on the MSCI's possible decision to consult with investors to change its methodology so Alibaba can be included?
So I want to be a little careful in using the term manipulating. I think what it is they're going to their methodologies and trying to find various causes to try to include Alibaba. I don't know if that's quite manipulation. But this MSCI is a really big deal. So yeah, on September 4th, roughly 2 weeks before the Alibaba IPO, MSCI suddenly announced that they're going to consult with their investors to see if China N shares could be included. And once again, this is a huge issue. It goes beyond just Alibaba. I mean, we're talking about all these major Chinese internet companies, aside from Tencent, like Sina, Weibo, Baidu, that aren't included in MSCI indexes right now. The way I see it, I mean, this is a step in the right direction. It's something that I certainly hope to see come to fruition.
Would definitely be a big boost for several companies. Thanks so much for your insight. We're going to have to leave it there. Dennis Hudachek, Senior ETF Specialist with ETF.com. Thank you.